Supermicro shares have been on a roller coaster in 25. They have reached $60 three times during the year, but they have also declined to around $30 several times. Their revenue is increasing fast, so that is not the problem. They went from 15 billion in 2024 to 22 billion in 2025. That is a 50% increase in revenue year over year. And then they project an even greater jump in revenue in 2026 to over 36 billion. That would be another 64% increase over last year's revenue. The problem is margins, and that they are shrinking for a while now. For the last couple of quarters, they were delivering margins of around 9.5% and 10%. And now, for Q2, they are predicting a further margin decline of about 3%. So their margin should come in at around 6.5% in Q2. That is the lowest margin that they have delivered over the last couple of years. I do understand the reason for that. They have a lot of upfront costs to ramp up production as they guided for a significant step up in their quarterly revenue. In the last couple of quarters, they have delivered between 5 and 6 billion quarter after quarter in revenue. And then there was one quarter in the spring of 25 when their revenue was only 4.6 billion. But then for this coming quarter, they are guiding for revenue of between 10 and 11 billion dollars. That would be an increase of around 100% quarter after quarter. So in theory, we should have a significant shift in revenue which requires heavy lifting upfront from the company. And if they step up and start delivering 10 billion plus in revenue quarter after quarter, then this all makes sense. So I'm not going to talk about this, as it should not come as news to anyone that the margins are going to be down in Q2. I rather want to focus on the future, because even if this is a one-off and an outlier, they still need to address it. They have to figure out how to lift their margins from the 9.5% and 10% they have been delivering over the last few quarters. So let's go through their options. Basically, they need to change their revenue mix and add new products and services. And to do so, they have to go beyond the hyperscalers and target new types of customers. Today, I'm going to look at the product side of things and how a change in their revenue mix could help to lift their margins. They said on the earnings call that they expect their building block solutions to significantly contribute to their bottom line. These products could deliver gross margins far above 20%. That is roughly 2 to 3 times what they earn on their high-volume hyperscaler orders. Importantly, their revenue from these products is marginal as of now. But they stated that they would like to increase revenue from this segment to between 20 to 30% of total revenue by the end of 2026. So let's look at the numbers. Let's take a 9.5% margin as a base case without any building block sales in their revenue mix. Because historically, that is what they have delivered over the last couple of quarters, except of the upcoming Q2 quarter. But we should treat this as a one-off. And let's assume that DCBBS comes with a 25% margin on average. So let's look at the different scenarios. If we assume that 20% of their revenue comes from DCBBS and related services, then their margin would be around 12.5%. But if they could increase it to 30% of their overall sales, then that would get them to around 14.2%. And if we go a step further, and if you increase it to 40%, then they could reach a margin of around 15.7%. The question is, what do they have to do to increase the sales of their DCBBS products and services? In the upcoming years, their best option is to focus on neoclouds, sovereigns, and larger enterprises. Because these customers, especially the sovereigns and enterprises, need more support and handholding in the process. So you can see how important it would be for them to be successfully expanding their customer base. Focusing on customers beyond the hyperscalers would open opportunities for them with clients who need more personalized services which come with higher margins. There are lots of people out there betting against Supermicro's success, and I understand the reasons behind that. Short interest increased significantly back in early 24 when the stock had that huge run-up to over $100. And short interest basically stayed high since then. You had the short report in the summer of 24, so that didn't help either. Now the questions are on the possibility of the stock being delisted at the end of 24 or early 25. High short interest is part of the story why the share price fluctuates so much and that the swings are so intense. But the interesting part of it all is that the short interest remains high even today. Over the last couple of months, short interest was around 17, 18 and even 19%. So basically, people are betting that the company will not deliver. And to be fair, shorts made a lot of money in 25, as they were right. Supermicro didn't deliver over the last couple of quarters. They have overpromised and underdelivered time after time. Their communication and planning is a shambles. It is probably the worst in the entire industry. They are always highlighting that it is difficult to project revenue on a quarterly basis, as these are huge and long-running projects. And they are right, I get that. But how come that almost every other company in the industry is doing better in predicting revenue? So they have to do better, as what they are doing is not acceptable. It is not acceptable to potential investors, but not even their own employees, who receive shares as part of their compensation package. The other part of the story that I don't understand is around the possibility for a share buyback program. Why are they not starting a share buyback program at all? This would put a floor under the stock, it would stabilize it, and it would also create significant shareholder value, especially if they buy back the stock in the 30s. So, Supermicro management, my question is, why are you not initiating a share buyback program? This would be in the best interest of potential investors and also the employees who have share options. As it stands now, Supermicro's management is leaving the company as an open prey to the shorts and inviting all of them to short the company and earn a lot of money. But if they could get their act together and deliver on revenue and start to increase margins, that would change the entire picture. What they need is to get on top of forecasting revenue, but also to build a revenue mix that delivers additional margins, as revenue without making any profits makes little sense, especially if you're in the business for decades and are not a software startup. Thanks for watching, and please give it a like, subscribe and watch another video. See you in the next one. Thanks. Bye.